Hi, this is James Eng of Old Capital, and today we're going to be talking about a June multifamily update. And I want to start off with this picture of what the world feels like today compared to, let's say, 2 years ago, right? So if you go and look at sort of, let's pretend this is sort of COVID right here at the beginning of the roller coaster. And then we had a dip here in Q2 2020. And really, Fannie and Freddie were the lenders of choice at that time because there was nobody else in the market. And then, really, starting in 2021 and up to probably Q2 of this year, it's really been this is sort of bridge loans have sort of taken over in terms of the number of transactions and what people are using. And then this is the pricing on multifamily. And so this graph is a little bit dramatic, but I think it gets the point of sort of Q2 2022 where we sit right now. With the Fed increasing interest rates, we're going to have to see where multifamily pricing goes. And so we're going to cover that in today's webinar, but then also just went through a deck from Sequoia Capital that they sent out to all their businesses and investors in terms of adapting to endure. And so we're going to run through a couple of things that while it was adapted to small businesses, I think it is applicable to multifamily owners and property owners throughout the nation. So let's start off. So on the left-hand side this came from Pinsford. And he says, a normal cycle is Fed talks about raising rates and markets sort of tank, and then the Fed backs off of that talk. And then eventually the markets rally. But with inflation, the Fed talks up rates, the markets tank, and then the Fed can't back off, right? So to me, this is sort of the first hike, the second hike, the third hike, the fourth hike, and they have to keep hiking and hiking because of this chart on the right. So every inflation reading that we've gotten, there was a slight dip in April, but May sort of bounced back above 8%, 8.5%. And so until this inflation cools, so this portion of inflation cooling, the Fed is just going to keep hiking. And so this was a bigger increase to 75 basis points this past week. And now, they have this thing hiking until close to 3.5%, 4% on SOFR. And so until inflation cools, they're just going to keep hiking. And then once inflation cools, then the markets will rally. So I thought this was an interesting piece from Pinsford in terms of going from this 8% inflation to the Fed hike until inflation cools. So how does this impact you as a multifamily investor? So the higher inflation, so we're still saying 8%, is leading to these higher interest rates, right? So there's two parts of the interest rate piece, SOFR and 10-year treasury. And SOFR is the front end of the curve, 10-year treasury is sort of the long end of the curve. Fannie and Freddie is based off 10-year treasury, SOFR is based off of floating rate debt. And so this is having impacts to buyers, right? So your debt service is increasing, which leads to lower cash on cash. Your interest rate caps are increasing. So usually you have to buy a 2% 2-year cap. That's gone from 2% of the loan amount to maybe 3% of the loan amount. So we'll look at that as well. So that's increasing your closing costs. And then because 10-year treasury has run so much, it is harder to refinance on these bridge loans, which is leading to lower LTV on the front end of these bridge loans. And so all these things are impacting buyers. And guess what? That's having an impact on you as a seller. So there's less buyers on the market. There's less tours. There's lower pricing. Prices are getting renegotiated, whether they're under contract or they're in process. PSA is getting signed, and buyers are just putting up less hard money. The market's changed so fast in terms of interest rates that people are a little bit more nervous about their debt options and sort of getting to closing. So it's been a seller's market for a very long time. But right now, buyers are now in control of this market and cap rates are expanding. So a lot of the data out there that, whether brokerage houses or banks put out right now, it's sort of Q1 data, which we'll look at. But right now, it has not reflected this change quite yet. So if you look at the two things that we talked about in terms of SOFR and 10-year treasury, let's take a look at federal funds rate. Historically, has been on a downward trend for the last, I don't know, 40 years, 50 years, since the 70s. And it seems like they hike for a little bit and then they come back down. So this is the forward curve on the bottom, and it has steepened dramatically. So before, it was going to take 5 or 6 years to get to 1% or 2%, and now it's getting to 3.5%, 4% within the next 6 to 9 months, is a prediction. So they're going to be right back up to this level on the curve. So while it's not as it's pretty steep, it's going to be sort of past the 2018 level, and then potentially get up to where it was in 2007. So prepare for 3.5% SOFR, or even higher potentially, if inflation does not calm down. So this is the first chart you need to be aware of, sort of forward curve on SOFR. And the second chart to be aware of is the 10-year Treasury. So 10-year Treasury, just in the last week or so, has really hit a spike of 3.5%, and it's come back down a little bit to settle around 325. Long-term average is around 325, I think, which is this red line. And so this is impacting the refinance risk on these bridge loans. And so the SOFR is impacting your day-to-day debt service, and then the 10-year Treasury is impacting what you can go to refinance Fannie and Freddie in year 3. And so that's what bridge loans are sizing to right now. So we'll go through all that. We'll touch on the Q1 sort of multifamily market update. I think everything's rosy in Q1. We'll talk about the current financing environment, sort of what we're seeing out there, and then wrap up with sort of some words of wisdom from Sequoia Capital in terms of adapting to endure. So my background, born and raised in Houston, went to school in Austin, have been up here in DFW since 2006, started as a loan underwriter at GE Capital, and was there sort of through the recession, 2007, 2015. And then now have been at Old Capital since 2015, originating close to 1.2, 1.3 billion in loans, and then investing in multifamily properties since 2015 across multiple markets: DFW, Austin, San Antonio, and Houston. So let's talk about Q1. I mean, Q1 was on pace for just a huge, obviously 2021 was the biggest year ever for multifamily. A lot of that was carryover from 2020, where guys just wanted to sell, and then a ton of portfolios went in 2021, and a ton of Class A deals went in 2021. And Q1 was still strong. Q2, I think, will still be strong. Another strong quarter. Q3, I think, is where we're going to start seeing a little bit of a pullback. And then we're going to have to wait until Q4 to see. But I think we're probably going to be in this range of probably 2020 for this year in terms of total volume. Pricing, it's still continuing to go up in Q1, but I think we're going to start seeing that level off, come down in terms of price per unit. This is the good thing about multifamily right now, is just that the vacancy levels are so low that you're still able to push rents and get huge trade outs. I mean, 15, 20%, and it's going to take some time, and these leases are going to reset. So I think this is the people are used to paying more for everything right now. And so if you're paying 10, 20, 30% more for everything else, like a 15% increase in your rent doesn't seem as bad. So, when everything else is going down in price, this is hard to swallow. But when everything's going up in price, I think people are sort of gotten the message that rents are going to keep going up. Probably not 15%, but it might still be in that 5 to 10% range next year as well. So this is the interesting chart. A lot of brokers keep pointing to this chart in terms of yield spread between the 10-year Treasury, which is sort of a risk-free rate, and your cap rate. And you really want it to be, in 2020, you had a 400 basis point spread. Now in Q1, it narrowed to 200 basis points, which is really around 2008 spreads. And then now pretend this chart was updated and it went all the way to 3%. And so at 3%, 325, your spread is close to 100 basis points. So you're right in this, 2006, 2007 spread timeframe. So something's got to give. Either 10-year Treasury's got to move, or cap rates have got to move up to create a bigger spread between the two. Because if you have the choice, you just go put your money in 10-year treasury and essentially get that 3.25% for free with no risk. So here's the options that are really out there right now in terms of people putting together their capital stack. The floating rate bridge guys, they're going increasing their debt yield going in to close to 5 to 6%. They're increasing their spread to 4 to 4.5. So your all-in rate on, let's say the SOFR goes from 1.5 all the way up to 3.5. Your all-in rate could go from 6 to 8% here in the next year and a half on a new deal, unless you buy a rate cap. And then fixed rate bridge is still out there. They're wanting 6 to 7% going in. And then Fannie and Freddie are still out there at 50% levered, 5 to 5.5%. So that's sort of your capital stack going in. Those are your options. Recourse bridge we'll talk about as well. But all these guys are sort of looking at the same cash flows. And so, in Q1, most of these deals were trading at 3.5%, 4%. So a deal with a $350,000 NOI had a $10 million purchase. If cap rates expand to sort of where interest rates are 5%, that could be, close to, 15, 20%, even 30% discount to that price. So 350,000 at a 5%, you get to 7 million. And so, it still has a long way to go. You're getting to about 60% leverage on Fannie or Freddie in that scenario. And so people are going to have to start looking at cap rate expansion, and then, the potential next 3 to 6 months, it might not get to this point because the rents might keep going up. And so your in-place NOI might go up to compensate for some of that. And so your purchase price might not go down as much, but the cap rate expansion is a real concern for a lot of people right now. So a lot of people are asking, how are my loans being affected right now? And this is really the math, right? So before, it was really 75% purchase, 100% of rehab was getting you to, a debt service of requirement of sort of 1.8 million. And so if you back that in, you're pretty much, let's say your pro forma is 1.7, that's going to only qualify you for about 68% of your purchase price at a 5% interest rate and 125 debt yield. And so that's the math that the lenders are doing in terms of having to figure out how to refinance these deals out in year 3, right? So if I gave you a loan at 75%, unfortunately, you're going to be coming up short. You're going to be at 115, 119 debt service coverage, and I want you at 125. So as the interest rate on the 10-year treasury goes up, so the chart that we showed earlier, it's gone now from, let's say, 275 all the way to 325. That 50 basis point increase, if you come in and increase this interest rate constant, your debt service is going to go up, and so your NOI has to go up. Obviously, your property's NOI forecast is not going to change, before you've even bought the property. And so what that usually means is that this is going to be closer to 65, 60% of purchase, 100% of rehab over time if that 10-year treasury keeps running, and it's going to be harder and harder to get out of the bridge loans if Fannie and Freddie is that high. All right, so you're getting hit with sort of higher interest rates. The forecast for interest rates is high, and so this is impacting your interest rate cap cost. And so this was from one of the subscriptions that I read, grants. Really, the 2-year rate cap at 2% SOFR costs 917% more than it did 6 months ago. And so right now it's sitting at 2% over 2 years, 342,000, which is 3.5% of your loan amount to buy this strike this week. And the reason is, they're looking at the curve and saying, look, essentially month 3, I'm going to have to start paying you, the person who bought the cap. So as you buy all these things, it's going to keep increasing. And so they're going to charge you a premium, but they're going to pay this out. So prepare that in terms of your closing costs, your interest rate caps. All right. So with all that great news, why multifamily still, in terms of there's still low vacancy in this market, which is driving rent growth. your leases are reset annually in this environment. So I think the inflation piece is going to keep going, but the leases are going to reset, so you're going to be able to drive rents. But the higher interest rates is also impacting single family. And so that's driving single family affordability. I pulled this chart out of an economic update, but pretty much a year ago, let's say the median house price was 330, your balance was 270. Basically, your monthly payment was about 1150 or 1250, I guess. And then today, the price of your house is 390 and your monthly payment is 1730. So your monthly payment has gone up by close to $500. And that is driving a lot of affordability problems for single family. And the way we have it here, I mean, I think it's even higher now than this when this chart was created back in May. So, and then there's an opportunity now to purchase these deals at sort of reset pricing. And if you can buy it correctly, hold it correctly, then I think you'll be well positioned. And I like this quote that they had in the Sequoia Capital: "You can't overtake 15 cars in sunny weather, but you can when it's raining." So it's raining right now. And for buyers who have been wanting to get into strong markets in higher quality assets, there's less people coming to the table. And so you can be one of those cars that overtakes in the rain, but you have to do it smartly. All right, so if you're gonna go out and buy right now, sort of what are your financing options out there and what they look like, right? All right, so bank loans, really 475 to 525, 3 to 5 year fixed. You're gonna be 20, 25 year AM on most of those deals. Freddie and Fannie right now, you're probably 5 to 525 fixed. It's going to have to be stabilized. Your leverage is probably going to be closer to 50, 55%. So you're going to put more down. And then non-recourse bridge, you're probably, SOFR plus 4.5. So your all-in rate is probably going to start at 5.5 and then go up from there. So you have to build that in and make sure you're able to exit in year 3 with your pro forma. And you're probably going to be 65, 70% levered on your non-recourse bridge. So let's go through these. So recourse bank loans, I mean, I think are going to start making a comeback, and we're already starting to do more of them. And this is where you sign personally, right? So if, let's say you buy a $10 million property, $7 million loan, then if the property does drop below 7 million, you get foreclosed on, and there is a balance and they sell it for $6 million, you're responsible for that $1 million. And so, yes, it is serious. It does put more of your assets at risk. They typically want you to put more equity, your own equity in the deal. So a lot of sponsors are used to putting 5, 10% of the deal of their own cash in the deal. They typically want you to put 20, 25% equity. But the benefit is you get a fixed interest rate for 3 to 5 years at, let's say, 5.5%. You don't have to buy in a rate cap, which saves you 3% of the loan amount. There's no cash flow sweeps or lock boxes. They typically can get loan approval early on in the process to sort of help you stand out in your competition. Your IO is a little bit lighter, so it's usually 12 to 24 months, and then your amortization might go down anywhere from 20 to 30 years. So most banks are doing 20 to 25 year AM, depending on the age of the asset. Your legal fees are significantly lower, closing costs are lower, and it's a lot quicker approval. So we're seeing a lot of people do this recourse bank loan on deals sort of 1 to 15. Over 15, it really gets tricky in terms of how many banks can really do that. They might have to, split it up and have multiple banks take it down, do a participating loan. So recourse bank loans, I think we're going to start seeing a comeback on these. Fannie and Freddie, they've been, I would say, a little bit more aggressive for what they call select sponsors. So people, let's say, with over $100 or $200 million with Fannie and Freddie, they're being more aggressive on their loans. And so you might see lower debt service, you might see lower spreads, especially if there's an affordable piece to it in terms of, the rents versus the median income. And so they're really focusing on higher quality borrowers. And so even at a, let's say, 4% cap rate, I think it's going to be higher, but let's say 4.5% cap rate, you could be getting into that 60, 65, 70% LTV. And I think that's when Fannie and Freddie will start winning more business, because if Fannie and Freddie are essentially the same leverage as these bridge lenders, then most people will take the Fannie Freddie debt on those. Bridge lenders, they're still very tight, I would say, in terms of minimums. They really have limited capacity, so they're really focusing on deals over 10 million, some even over 20 million as minimums. And then they're really narrowing down onto primary markets. And so they're not going out to secondary, tertiary markets as much. So primary markets, sort of north of 20 million, is where you're going to have the most competition for deals. Spreads are really 4.5 over SOFR right now, just because of pretty much every time they go out to the market and securitize their loan, or they see another person securitize, they want to see where that pricing ends up. And so because the interest rates are going up, risk-free rates going up, spreads are having to go up as well. The borrowers need to definitely price in the rate increases into their pro formas, higher debt yield tests. So if the Fannie and Freddie rate is 5.25, 5.5, that's what they're going to exit to. So your debt yield is going to be north of 8 on most deals. And these interest rate caps, right now most are still requiring 2 years. And then they might also have a trigger in there that once it hits 2%, you have to buy the rest of the term. So watch your interest rate caps and build in probably about 3% of the loan amount in interest rate cap costs right now. All right, so now that maybe you've bought some deals, maybe you own them now how do you make it through this cycle? And Sequoia Capital, which is one of the largest VC firms out there, put out the deck, Adapting to Endure, to all of their business owners and founders and startup guys. And a couple of comments that they had around the economic overview was capital was free, right? So when you drop the federal funds to zero, capital is free. But now as it goes up in price and they raise the rate, it's going to be significantly more expensive, and your impact on valuations and fundraising is going to be significantly harder. And COVID was very quick, right? So we were down for about 3 months, and then now it's shot back up. You could barely see the recovery on the chart back there, and it was very quick. But now they're expecting the recovery to be longer, right? So they don't really have a timeline on here, but it could be 12, 18, 24 months for consumers, supply chains, all that type of stuff to come back. And so, their biggest thing was you have to be able to adapt, and you don't want to be this orange line. So this orange line is really, they called this May of 2022. You have your expenses going up and up and up and up and up. And then all of a sudden you realize halfway through that is unsustainable, right? So this might be distributions, it might be the cash in your account. You really have to start conserving this so that you can survive, because the death spiral in multifamily really is when you run out of cash to turn units, to pay debt service, to pay your loan, then all of a sudden you start not turning units, your occupancy drops, your NOI drops, you can't pay your debt service, your cash flow gets swept, and then all of a sudden you're down here at zero, right? So what you want to do is start reviewing your balance sheet, reviewing your P&L right now, cut the things that you don't need, and then really sort of build through this recession timeframe and improve your company and your property over time, right? So a couple things that I would say is, look at, your property taxes, your insurance, your interest rate cap costs, and start having a conversation with your investors in terms of distributions and making sure that you're reviewing all your expenses with your property management company. This is probably the biggest thing is if you do have a maturity, let's say in the next 12 to 18 months, starting to move those to longer term maturities, whether it's moving the agency, moving to a recourse bank loan, something with a flexible prepay so that you can still sort of sell in years 3 through 5, but gives you a little bit more time in case you don't hit your plan. I would be over communicating with limited partners right now, existing ones, in terms of what you're seeing in the market, and then also potential ones. So existing ones definitely focus on the property, and then potential ones focus on sort of how you're underwriting deals right now, so that when a deal does come available, then you are ready to go. As a general partner, also, I would be creating some liquidity on your personal balance sheet in case you need to support some of these deals, and really focus on operations, right? So a lot of times I was out on property tour yesterday, and I guess sometimes you get caught in the world of interest rates and LTV and debt service coverage. That when you go out to some of these properties, it's really just the blocking and tackling of leasing units and tenant satisfaction and doing work orders. And so right now, especially as an owner, I'd be focused on making sure your buildings are full, the tenants are satisfied, the leasing agent's doing well, your CapEx is up to date, doing all those things. So really focusing on operations right now and making sure you're hitting the numbers that you promise your investors. And then, when you go out and buy right now, their piece was, focusing on profitability, which in multifamily is really focusing on in-place cash flow, right? So if you buy a deal at a 125 cover on in-place cash flow with fixed rate debt, then you can sort of guarantee that cash on cash return to your investors. And so focusing on near-term certainty. And so with every crisis, there's opportunity, right? And so this is going to flesh out some people who are less prepared, some companies that are less prepared, properties that are less prepared. And so there's going to be opportunity there, but you personally have to be ready to go. So it's going to be an opportunity for new buyers to that maybe haven't been able to get into major markets, haven't been able to get into bigger deals or higher quality deals. And but you're gonna have to survive the deals that you're in, right? So there's going to be opportunity out there. You just have to be able to capitalize on it. All right. So this is some of the closings that we had in Q1. Q2 will be about the same. Majority of it was non-recourse bridge, Freddie Mac conventional, some Fannie Mae. But I would say in Q2, once we close it out, it'll be more recourse bank loans on the sheet in terms of closings. So coming up in September is the Old Capital Conference. So this is a sort of once a year event, annual event that we do, have 500, 600 multifamily investors there talking about this market. And so this market is changing quickly. So this is one of those that you want to attend. You can go to oldcapitalconference.com. This is our 6th year that we will be doing it. So Old Capital is a mortgage broker, right? So on the first slide, we showed sort of, all right, Fannie and Freddie, right after COVID, were dominating. Then it went to bridge loans. And now as the market changes, you're going to have to adapt, and you're going to have to probably go to a recourse bank lender for your deal. And so as a mortgage broker, that is our job, to find you the best loan for you at that specific time that you're buying the deal. And so we constantly are in the market sourcing new debt options for you. So we help you sort of before the deal, during the deal, and then definitely after the deal. So that is our definitely one of our advantages of working with us. If you like what you heard on this webinar, definitely subscribe to the YouTube channel. If you need help with a loan term sheet, send me an email, sort of T12 rent roll OM whisper price. And then if you're looking at investing in a deal, happy to look at any investment package to go through it, answer any questions on the debt. And then really the first, let's say you don't have a deal, you're just sort of getting started, complete your personal financial statement, and then set up a time to talk with me, and we can talk through the deal. And then, Old Capital is constantly hiring great people. So if you're interested in joining Old Capital, send me an email with your resume, and we can go from there. So appreciate everyone joining, and we'll talk to you soon.